Welcome to our advanced concept class about Forex market hours. Now, I started my career as a stock trader. I started back in the mid-90s, started in equities, and, cut my teeth doing that. I started out, doing some day trading. I quickly found out that, hey, this is pretty hard. I moved more to some little bit intraday to swing trading strategies. Then I moved into the options world, moved into futures, and thought to myself, you know what, I've got this trading stuff down pretty well. So I thought, I've always heard about the currency market. I wanted to start dabbling in it. So I started dabbling in the currency market about 4 or 5 years ago. And I figured, look, I understood how to trade stocks. I understood how to trade futures. So I thought to myself, Forex would be a very easy, natural fit. I figured there was a little bit for me to learn, but that was it. And when I got into it, I found that it truly is a different animal. Forex trading is a different animal. Now look, it's the same thing we're looking for. Buy low, sell high, buy outperformance, sell underperformance, relative strength. I mean, it's really the same concept. But as far as the marketplace, it was truly different. And it really took me some time to figure out, okay, how is this to be done? Some of the things that, were successful for me in stock trading just frankly didn't quite work out. And there's some things that happened that I didn't understand. Most of it came down to not really understanding the Forex market in general. So that's why we want to have this course, is for everyone to have a good grasp on the Forex marketplace. Now, when I first started, I remember thinking, I don't even know when the market opened. I didn't even know when the market closed. People are always talking about the Asian session. I didn't even know what that was. So let's go over real quickly open and closing. So when does the Forex market close? The Forex markets open at 5:15 p.m. Eastern Standard Time on every Sunday. Now I live in Mountain Time, so that's at 3:15. You live in Pacific Time, that's going to be 2:15 p.m. The markets are open 24 hours a day, all the way until 5 p.m. on Friday. Now, if you are a stock trader, then you actually get a bunch of days off during the year. You get President's Day off, you get Martin Luther King, you get Easter, you get Memorial Day, you get Labor Day, 4th of July. As an FX trader, I'm sorry, you get almost nothing off. There's only 2 days during the year that Forex is going to be closed. Christmas and New Year's. And guess what? If they happen on the weekdays, they're not closed at all. In 2010, both Christmas and New Year's were on weekends. So the Forex market was basically open every single day of the year. Now I remember thinking to myself, well, why in the world? This is a very strange time. Why do we open up at 5:15 p.m. time on Sunday? And then, I understood the close, but I didn't understand, wow, why 5:15 p.m. on Sunday? And what we talk about, folks, is that the Forex market is not like the stock market. It's not like the New York Stock Exchange. That we all know that at 9:30 a.m. Eastern Time, when that bell rings, trading starts. And at 4 p.m. they close the markets and it's done. Forex does not have a marketplace. It does not have a physical location. The Forex market is a collection of banks. It is called the interbank market. This is banks are trading currencies back and forth. Not only banks, but not just trading, is that companies are moving money around the world. People are wiring money from the US to Australia and from Japan to Europe. There's all this money going on all the time. And so what we need to understand is that the Forex market is really just a bunch of banks. So the question we have to ask ourselves is, when do banks open? Well, there is virtually a bank open every single minute of the day. And in New Zealand is the very first country that opens up for trading. And that happens at 5:15 p.m. on what's our Sunday. For them, that's Monday morning. So Monday morning, the banks open up in New Zealand. Now once those banks are open, the Forex market is open. Realize though that there's only a very limited amount of banks that are trading at that time. And shortly after that, the Australian bank opens up. So as you can see down here, the Australian banks, they open up for trading about 45 minutes after that. So about 6 p.m. Eastern Time, the Australian banks open for trading. All of a sudden we have more banks. Now we have New Zealand banks and Australian banks are open for trading. They're making currency transactions, they're trading with other people, they're trading with other traders. And then we have about 7 p.m. we have the Japanese banks open. So now as you can see, more banks are opening up, there's more liquidity, there's more trading. The first of the banks to close is going to be the New Zealand bank. It's going to close at about 2 a.m. our time. So at about 2 a.m. the New Zealand banks are going to close. The Australian banks close about 45 minutes after that, and the Japanese banks close an hour after that. So once those banks have closed down for the day, they're no longer really open for business. However, as you can see, right around 2 a.m. Eastern Time is when the European banks open for business. So I want you to see that there is an overlap. There's an overlap where we have a lot of banks open at once. We have all the Australian banks, all the Japanese banks, all the banks in China, India, they're all open. And we also have the European banks open for business. At this period, there's going to be a lot of currency transactions going on. And once the Asian session, and we talk about the Asian session, we're specifically talking about Australia and Japan, once they close for business, then it is what's called the European session. The European session, London opens an hour earlier. So London opens at 3 p.m. in the morning, 3 a.m. Eastern Standard Time. And you can see that we have about 4 hours here where it's strictly European banks. There's no Asian banks open, there's no U.S. banks open, there is just European banks. 8 a.m. U.S. markets open. You can see there is a period of time for about 2.5 hours where we have both U.S. and European banks open for business, making currency transactions, facilitating their clients, moving money around. And then it closes, and then we have the U.S. closes at 5 p.m. As you can see, right after that we get the New Zealand opens. So again, this is why you will see that all day long you have quotes on your MetaTrader. Remember, what we've done is we've put together all these banks. We have all these banks to trade with through our liquidity provider. So at any time during the day, one of our traders wants to make a trade, there's going to be a bank that's showing a bid and the ask. Now as we talk, we're going to talk about this in Forex 101 Session 2 that if there's not a lot of people trading, there is going to be wider spreads. If there's a lot of people trading, there's going to be tighter spreads. We're not really going to discuss that tonight. What we are going to discuss is that there are certain periods of time during the day that you need to know about that are going to have the most amount of volatility. This is something I didn't understand. Let me explain to you just how the FX market works. And many of you have already seen this, but too bad, you're going to see it again. All right. In the stock market, we know that the market opens up at 9:30 a.m. and it closes at 4 p.m. There's lots of trading activity that goes on that day, but at 4 p.m. the bell closes and there's no more trading. However, there's a lot that goes on after the market closes. We've got earnings reports. Again, we have companies that are announcing earnings. Now this is going to affect trading. But remember, the market's closed. No one can trade on that information. Then we have the Asian markets open. So imagine if the Asian markets crash 2% that day, it is going to greatly affect trading in the US. However, no one can make any move on that news. They have to wait till 9:30. Then next we have the European session. So let's say European stocks crash 4%. So now we've got bad earnings reports. The Asian markets were down big. The Euro markets are big. And then in the morning, we get economic reports. By the time the bell opens at 9:30, there has been so much energy built up that there's an absolute explosion of energy. And the trading is fast and it's furious and there's lots of activity, there's lots of volume, and then at 4 p.m. the market closes. And we do the same thing over again. Earnings, Asian session, European session, economic news. And then the next day, again, more energy has been built up and we get trading action and we get volatility and movement. And then at 4 p.m. it's over and it sleeps. The market sleeps for over 18 hours a day. It's not open. You can see that in that scenario, a lot of energy can build up. And when the trading is finally released, you can actually get a sustained flurry for 5 to 8 hours of activity. However, in the currency market, it's open all the time. There is no way for the currency market to always be trading all the time, 24 hours a day, 5.5 days a week. There's not enough energy. It's totally, totally impossible. So what we have to understand is that we're not going to get the same type of movement in the currency market that we do in the stock market. And this is one of the things that to me was fairly confusing. Hey, I got into a trade, nothing's happening. Why isn't anything happening? And then all of a sudden, nothing would happen for 4 hours. The next thing I know, there's a giant move of like 100 pips out of nowhere, I thought. And I thought, oh my gosh, what is going on? This doesn't happen in the stock market. Stocks don't go sideways for 4 hours and then all of a sudden they spike in 15 minutes. To me, it took me a little bit of time to really figure out what was going on. And what I didn't understand is that the currency market can't trade with volume and energy all the time. There's going to be long periods of inactivity, followed by short bursts, followed by periods of inactivity, followed by big bursts. This is how the currency market trades, folks. This was the big thing I didn't understand. I didn't understand that it couldn't trade like the market, like the stock market. It's its own animal, it's its own beast. We talk all the time about trading Forex. You cannot trade it all the time. these areas I'm circling in yellow, these are what I call untradable markets. You're going to see that these are the majority of every day. If you take a 24-hour period, there may be 18 hours that are untradable, meaning that there's very, very little opportunity to make any money whatsoever. In Forex, what we must do is we must look for and focus on the opportunities that we can make some money. And you can see here that these are literally maybe an hour to 2 hour windows open throughout the day that you can actually go and make a profit on. One of the big things, again, I'll say this again, I didn't understand at first, was that the Forex market, you should be sitting on the sidelines for most of the time. The more you try to put your money into the market, I'm telling you, the more you're going to spend on spreads, the more you're going to get knocked out during these low volatility periods. It's going to be a frustrating game. You have to trade Forex with the understanding that you have to sit and wait and be patient for these moves. And when they come, most of the time they're fast and furious. So what I wanted to discuss with you in this session was, when do those flurries happen? Now there's a lot of things that make those flurries happen. News is one of them. So whenever a news report comes out, either news or an economic report, that causes a flurry of activity. Sometimes we will trade around news reports since we know that that's going to bring a flurry of activity. The other way we can predict these flurries of activity is based on the Forex time chart. We know that there are certain periods of time throughout the day that there's going to be a lot of volume. Understand, a lot of volume doesn't automatically mean a lot of volatility, but you can't have a lot of volatility without a lot of volume. That's one of the ingredients. So let's talk about some certain times during the day where you're going to get the most amount of volume. The first one I want to bring up is the time period where the European and the US sessions overlap. So during the 8 a.m. to noon Eastern Standard Time period is typically the most volatile period of time during the day. The other most volatile period of time is from 2 a.m. to about 4 p.m. 4 a.m. Eastern Standard Time. This is the time when the Asian and European sessions are open. So when we take a look specifically at time periods, you're going to see the biggest moves typically during these time periods. 2 a.m. to 4 a.m., which is super convenient, isn't it? Isn't that super convenient to be a Forex trader? And also during the 8 a.m. to noon Eastern Standard Time period. As a Forex trader, these are periods of time during the week where we know that there is a predictable possibility of there being a volatile enough move for it to make some sense. On the flip side, the slowest time, the lowest volume time, is after the Asian sessions have been open for a while, the Australian markets have closed, it's just a few banks and the European session hasn't set up yet. Now this session here, this, in my opinion, is one of the most dangerous sessions as well. And I say that because we see a lot of little false moves in this session. Now we're going to talk about it specifically. This part, again, specific, there's a lot of false moves. We've seen this before in our trading interview. You've been with us for a while. It's very, very typical and easy to get stopped out on a good trade during this time period. We're going to talk about this. We're going to discuss this here in a little bit. Right. So let's talk about the most active currencies by time. Now, as you can see here, this shouldn't be a surprise to you. These are very regional currencies. So in the Asian session, we typically see the most volatility in the Asian currencies, which are Australian dollar, New Zealand dollar, and Japanese yen. The European session, no surprise, the euro, pound, and the Swiss franc. In the American, US dollar, and Canadian dollar. The reason why this is remember, a big chunk of the currency market is not the traders themselves. It's banks moving money around the world. It's people wiring money here and there, and there's movements, and there's businesses that are collecting payments from other countries and bringing it back home. This causes there to be more volume and more action for these. So, we need to also understand what currency pairs are the most volatile. So let's talk about most active pairs by time. Now, in the Asian markets, we typically see stuff like Australian dollar, Japanese yen start out to be the most active. Because remember, during this period of time, banks are open, people are doing business. There's a lot of business going on between Australia and Japan, and these payments are going back and forth. However, later in the Asian session, you're going to start to see stuff like pound yen, euro yen, and even stuff like pound Swiss franc, which I found surprising. They're going to start to pick up some volatility. Because what's happening is traders are positioning themselves for the European Open. They're getting themselves ready for that European Open. So in this period right between the Asian and European session, I don't want to be too overly dramatic, but I'm going to go ahead and call this the danger zone. The Asian session is typically the lowest volume and typically the lowest volatility. Now, whenever you have low volume, what this means is that if a big player comes into the market, they're going to affect the market more than normal. And an example is with stock. Let's say there's a stock that typically only trades a couple thousand shares a day. And let's say someone comes in and wants to buy, they want to sell 200,000 shares of that stock. That volume alone is going to cause wild price movements. And then once that person is done, it's going to go back to a normal market. Same thing that happens in the end of the Asian session. We have very, very low volume. Very low. And you typically see lots of little head fakes. You see lots of false breakouts. Again, this is a very common thing. We see a currency that's trading at a high base, and then right before the European session it breaks out. Most of the time you're going to see that that wasn't a breakout at all. So we usually do not like to take any positions in this time, and this is typically from 11 a.m. to about 1 or 2 a.m. 11 p.m. Eastern Time to 1 or 2 a.m. Eastern Time. In the European session, we've got mostly the European crosses. Pound, Swiss franc, euro, pound, US dollar, Swiss franc, pound, US dollar. And again, US Canadian, and no surprise, but again, this is people positioning themselves for the American Open. In the American Open, Euro US dollar rules, and also US dollar Japanese yen. These are the two biggest volume pairs during the American session. The reason why we are going through this is so you can understand a little bit about Currencies' personality. You can understand that these currency pairs are going to be more volatile during different times of the day. Now, of course, anything can happen on any given day. You know, you might get US Japanese yen that's very volatile during the Asian session. You know, but these are generally how they work. They generally, on average, are more volatile around these periods of time. So this makes sense when you're looking to take a position. Think to yourself, okay, is this the appropriate pair to be taking in a position during this appropriate time? If not, you may want to look for a more appropriate pair. Let's say you're looking to trade on the European session and you're looking at the Australian dollar Japanese yen. You may say, you know what, I like the yen, but I don't know if the Australian dollar is the best cross against it. You may look at doing something like the euro yen, where you think that it might have a little bit more movement in it than the Australian dollar does during the European session. So again, this is where I said to you is that it took me a little bit of time to transition from stocks to Forex, because these are the little things I didn't understand. I just thought, hey, the market's going up, let me buy. Well, what you buy, what pair you buy, during what time period is going to have an impact on your results as a trader. Alright, so let's talk about the most important times in the FX marketplace. Alright, number one I put down here, market open on Sunday. Market open on Sunday is usually a pretty low volume affair. Remember, the only banks open are the New Zealand banks. The spreads are typically fairly wide. There's not a lot of movement. However, this is when we are going to get gaps. This is when we're going to get changes in prices. So for instance, let's say that we had pound Japanese yen. Pound Japanese yen on Friday, let's say it closed at 129. We may see that on Sunday this opens up at 128.25. There is now a gap in prices. This is a generalized thing. Again, of course, on any Sunday we can see all manner of movements. But generally speaking, when we see these gaps, they typically tell us the overall direction that this currency pair is going to take. So when you see this open up down at 128.25, let me tell you what typically happens. It typically does something what is called fill the gap. And any of you who have been stock traders for a while, you've heard this before. It will typically trade back up to the closing price on Friday before it eventually turns and falls down. So by watching these gaps, by seeing where these gaps are and seeing how these stocks react, how these currency pairs react, it can really give you a good idea where the first day or two moves of the market are going to be. So a down open on pound yen probably tells us that the movement, at least early in this week, is most likely going to be to the bearish side. And an opening at 129.60 is going to tell you that, hey, there's most likely going to be an upward bias here this week to the move. We don't like to make a lot of trades early on Sunday because the spreads are so wide, the volume is so small. However, these gaps tell us a lot of what's going to go on in the next day or two. The other more important time, again, is the London Open. 3 a.m. Eastern Time. Now, London is considered the headquarters of Forex. Even though there's no markets, most of the trading volume goes through London. And I want to say it's something like, 40 to 45% of all of the volume of Forex is traded is routed through London. So again, it's a huge open. It's a huge open. We typically see lots of price movement around this period of time. Once we see all that volume kicking in, remember, the volume doesn't always equal volatility, but you must have volume to get volatility. So the London Open is a great time where we are pretty sure where there's going to be a tradable move. Now, whether that's up or down, that's for us to do our research. That's for us to use our charts and make that call. But remember, you can only trade Forex when there is movement. If there's no movement, you want to be on the sidelines. You want to be out of the Forex market most of the time. You want to be in it when the energy is there. Then the other one, which is much more convenient, unless you are a night owl like my wife is, much more convenient for the U.S. Open. Now, around this U.S. Open, you also tend to get a lot of economic reports. So always check the economic calendar. We go through it every Sunday in the FX room to make sure that everyone's up to date. So check the calendar. You might find that there's a big report tomorrow morning. Use that in your trading to decide, hey, is that going to be too much volatility for me to take on, too much risk, or do I like a position going into that report? So London Open and US Open every day is where we typically see the most volatility. And again, let's just go over this again. This is we've already seen this. But these are the periods of time where we typically see the most trading action. As I said earlier, on any given day it could be totally irrational. But if you continually watch Forex day after day after day, this is where you're going to see the moves happen. Now this is where you get to decide as a trader what it is you're looking at. We have all different traders here at Maverick. We have some traders that are more short-term. They like to hold for 30 minutes to 2 hours. We have some of our traders that are a little bit longer term. They like to hold for a couple days. We even got a couple traders that they typically hold on for a week at a time. They usually take a position early in the week and they hold it all the way throughout Friday. So realize that this is going to affect traders a little bit differently based on their time horizons they're looking at. But if you're going to be in the market and you're looking for a shorter term trade, most of the time you're going to see the best trades and the biggest returns during these periods. So you have to decide to yourself, okay, what type of trader are you going to be? I know some traders who will set their alarm clock for the London Open. They'll go to bed at like 10 or 11 o'clock. They'll wake up 4 hours later, watch the Forex market for 2 or 3 hours, and then go back to sleep. I've done that lots of times. But I've also made the decision that that is not a real healthy way for me to live. You know, I've got a wife, I've got kids, I've got other things going on, and when I do that too much, I am a walking zombie. Because then I always wake up for the U.S. stock market open at 7 o'clock, 7:30 my time. So I made a decision that, you know what, I'm not going to trade the London Open. I don't mind taking a position overnight, but I'm just going to put out an order. I'm going to put out my protective stop. If I get hit, I get hit. If I don't, I don't. I don't play a lot overnight. Most of the trading I do is in the morning. in the US Open period. However, that may not fit your schedule. You may find out that your schedule is you are a night owl. You want to trade that London Open, that's fine. The worst time though to play, folks, the worst time to play is going to be right here in this period. Let me kind of circle the worst times to play. So that's going to be 5 to 7 p.m. Eastern Time, and right here. And again, I labeled this earlier as the danger zone. That is way too dramatic of a name. It's not that dangerous, but I want everyone to realize that this period right here, there's a lot of false breakouts, there's a lot of false moves, there's lots of stuff that can catch you. And I really don't like to make trades, you know, let's say at about 11 o'clock my time, because I know that I've got to hold the trade through the danger zone. I know that during that period of time there's going to be this fluctuation, and I could easily get knocked out of a trade. I can't tell you how many times I've been knocked out of a trade in that period of time, and then when the London Open came, my trade went exactly how I thought, but I ended up not making any money on it at all. So this period of time, these are the periods of time we'd really like you to not initiate any new positions. Wait for a better time, because for the most part, if you enter a position here, you may have to sit through some long periods of inactivity, and then you're going to be into the danger zone. We think the best trading is really done in the early mornings Eastern Time, maybe 4 or 5 a.m. Eastern Time, all the way up to about maybe noon to 2 p.m. Eastern Time. That's where you're going to see your best times of volatility. Right, and the last thing I wanted to go over with you, since we are talking about periods of time and we are talking about volatility, is seasonal volatility patterns. You're going to see this is very, very typical of what we see in the stock and bond market. So this should be no surprise to us that the lowest period of volatility is typically in the March through August. And again, there's always this saying in the market, sell in May and go away. It's typically where we're going to see the lower volumes and lower volatility in Forex. So end of the year, beginning of the year is almost always the best time to trade Forex. It's too bad we just can't always be trading in December and January and February, but the market is what it is. So keep that in mind in your trading. Realize that you're going to have more opportunity early in the year and more opportunity late in the year. And during the summers, we really see the volatility start to shrink. So we should be building this into our expectations. Last year, we had a very good first part of the year. But remember, we had a great May. We had a fantastic May where we were up right around 600 pips for the month. And that was because we had a lot of news with the European debt crisis. But for the next 3 months, we struggled. We struggled to make over 200 pips a month, which is kind of what we've set down as our goal. And that's because the market was just not very volatile. And I think we were right around 200 or right below that for those entire 3 months of the summer. And then once it picked up again, we had a much better September. So realize that these seasonal volatility patterns are going to affect your trading as well. So if we get into some summer trading and you find out, hey, I'm just not finding all that much opportunity, don't be surprised. That's what summer trading is all about. All right, well, let's go ahead and wrap this up, guys. And gals, I guess. Sorry for being so sexist. You must have an understanding of the Forex markets. When I got into this, I thought, hey, I know stocks, I know options, I know all this stuff. When I got in, it baffled me sometimes the moves we were getting. It baffled me. And so it wasn't until I really understand how the Forex market is different that I was able to really start to customize and tailor my trading plan to capture the market I was trading. Number 2 here. You must understand the Forex market is untradable much of the time. This again was the other mistake I made at first. Was I thought, hey, the market's open. I see movements. I see blinking lights. I see stuff happening. So since it's open, since there's blinky lights, then there's probably a trade to be made. And I would go and make a trade during that slow Asian session. And then of course I'd get knocked out during that session before the European session, and I would have a loss. Forex is a game where you sit on the sidelines most of the time. It's a lot like poker. You sit on the sidelines waiting for the good hand to be played. And then of course watch out for that 30-minute period before the London Open. So we call it the danger zone. Alright, well hopefully folks this has helped you understand a little bit more about the Forex marketplace, a little bit more about how and when to make trades. And of course we haven't gone through, and wasn't the purview of this class to go through your charting, how to enter the trades, how to hedge it, how to go in and do everything. That's and everything else. But we want you to have a good understanding of the game of Forex and how to play it. All right, so thanks a lot for joining me, and we'll see you everyone later. Goodbye, everyone.